Hello again. This is Josh Carr with The Real Angle, and today I'm speaking with Adam Fruitbine, Chief Investment Officer at Maxx Properties. Adam, how are you doing today?
I'm good, Josh. Thanks for having me. Appreciate it.
Good, good to have you too. So one thing I always like to say for those on the audience, because invariably someone will always ask if I don't say it, the web address is maxxproperties.com. Always like to get that out there because
Yep.
the modern world, the first thing everyone does is Google stuff. Um, so yeah, let's start with the basics. You're CIO at Maxx Properties. How long have you been there? Where were you before?
So I've been with Max better part of 7 months, going on 8. So relatively new to the program, and I've had a 25-year career in real estate. Uh, Majority of that has been either on the investment sourcing side as an acquisitions investment person, or on the capital market side, raising capital or connecting real estate to capital and vice versa. So buy side and sell side hybrid, but here at Max, as CIO, a little bit more focus on the investment side.
Right, and assumedly, because you guys, I mean, Maxx Properties has been around for how long? It's an established.
86 years. Yeah,
Right. So I'd
long
imagine
time.
by 86 years, you're not as much in the fundraising mode as you would be if you were a startup or what have you. Imagine it's more about
Right,
deployment.
right. Although we will talk about some of that strategic expansion with capital as we progress here. Yeah.
Great. Excellent. Excellent. So yeah, so let's talk a little bit about the investment thesis because that seems relevant. So what markets you're currently in?
So just quick history, and that'll answer the
Please
question. So
go
so
ahead.
Max was founded in 1936, family-backed business, single family. Uh, Started investing at its origin in New York City real estate in the boroughs in Manhattan, small, mid, high-rise apartments. Some converted to co-ops, some converted to condos, and that really continued for the first, let's say, 50 odd years. And so only
Okay.
recently, in the early mid 90s, was there a strategic decision amongst the third and fourth generations of the family to start to divest some capital from New York City and redeploy capital into growth markets in the mountain states and the West, Southeast. So you speed forward to today, we started with zero in 1936, and through a lot of generational acquisitions and some dispositions, we now today own roughly 10,000 units, 2 billion of assets under management just in the apartment sector. And we're active in Denver, Salt Lake City, Phoenix, Las Vegas, Central and South Florida, North Carolina, and still maintain a pretty strong presence in the New York City, New York metro area. But a lot of that has been transferred over time. And so I consider us a national multifamily vertically integrated owner operator because we have a 300-person team, our own verticals of property management, accounting, all the things that you'd expect a full service group to have. We only serve one client though, one family for the moment, but that I expect to change.
So couple things you hit on which are interesting. So if you had to not guess, but if you had to say, like what percentage of the portfolio is still New York City as you've divested away from that?
10 to 13%.
Okay. Okay. So
Yeah.
still sizable if you're talking about the dollar amounts you're talking about, but yeah, you're not really a New York you're not by any means a New York exclusive operator. And and I'm curious when you talk about how they decided to move money into other markets and
Right.
it's one family. I mean, it's basically a family office.
Right.
Um, and this is just curious. Did they deploy money into other things other than real estate, or were they by diversifying they just said simply let's do some other real estate assets?
Well, the portfolio is predominantly in the rental apartment space, and as
Okay.
far as the family's holdings and general wherewithal, I mean, they did grow up in the source of their equity and a lot of their wealth came from real estate. So not surprisingly, a lot of it is there, but they certainly have
Sure.
diversified into other investments, and so, but it's a real estate family.
Right, and Max Properties focuses on the real estate stuff, not whatever else they may or may not be doing. Okay. And most of the stuff you're doing now, is the goal to do, are you looking to do value add stuff, buy existing product, ground up development? What's the vision, I guess, as you're growing into these other markets?
So the lion's share of what we do is buying existing and not so and stereotypical family office. We're looking to acquire assets, put long-term debt in place, and hold them long-term. And so
Okay.
The metrics are current income, long-term appreciation, refinance periodically, and reinvest that capital, sell assets, 1031 to others. So there's a lot of estate planning and tax management involved in that. Uh, but as we go forward, and again, we'll get into that. I see strategically we'll be growing to the point where we want to be active, and we've already started being equity partners in some sponsored deals, particularly for development. So we've done some equity JVs with developers. We provided GP capital to some sponsors, particularly in the LIHTC sector, where we don't have that expertise, and so we would choose
Sure.
to leverage another group. So, on the edges where we don't feel like it's a core competency, we will leverage other specialists.
And let's talk about that. So on LIHTC stuff, low income housing tax credit stuff,
Yeah.
when you're partnering with these developers, are you, in those cases, are you looking to be the takeout because you want stabilized product and they're building it and then you're the takeout, or is it just more like you're working with them as you're a co-developer and then you're flipping it out to someone else?
Right. So the development is in market rate, and the LIHTC has
Right.
been focused on pre-existing acquisitions. But
Got it. Okay.
on the development side, usually, well, we would like to be in these assets long term, and we pick our partners who have a similar point of view. So a lot of the merchant builders have not until recently been on our radar, and then on that one opportunity where we're doing something with an operator, there it's a medium term hold, sort of called a core plus opportunity. Where we're partnered together, knowing that there is going to be a mutual sort of hold period, but yeah, I mean, nothing is necessarily done with IRR in mind. It's a bit of more current income and orientation, but uh, I think generally speaking, it's been medium to longer term holds historically.
Got it. Got it. Got it. So, so you've alluded to it a bit. Let's talk about sort of the broader strategic plans that you mentioned. I mean, so traditionally you've been a family office. You're deploying the money for essentially one family. You're now looking. You've got this operational capacity that you built up over decades.
Right.
So you're looking to maybe work with other family offices. Like, what are you looking to do? Do you think?
Sure. So first, really what we do right now is sort of we have one track, which is we are looking to maximize value for our family business. In complement to that, going forward, and as part of our strategic goal for the next 10 years, our intent is to really take what has been it's a formidable operating company, and really our presence in these markets has grown over time, and selectively start to invite other investors to join us and to be buyers of product, maybe recap existing opportunities or within our portfolio. But
Okay.
the real point here is the next we've taken the first step with geographic growth over the last 30 years. Now the thought is, well, let's talk to some folks that have looked to us for years for options to invest, and maybe we'll say yes this time, and we'll start to put together a little bit more of an investment management capability where whether it's institutional equity or other taxable like kind investors, we'll start to look at aligning for short and long term type investing.
Okay. So then you're doing like a GPLP type structure, or bringing in partners,
it,
or
it would be a complement, and probably look at some things that are a little bit more IRR driven, because I think
okay.
that's probably where we have wanted to go. And I think that that's an opportunity also to align with folks who similarly look for value add or risk adjusted returns on a shorter to medium term hold. And that would be a complement, different products. So there's no conflict in sort of strategies.
Right. Okay. So you still, and that makes a lot of sense, right? Because otherwise, the question is when you find the deal, where
Right.
does it go, right? So if you're talking about stable current yield type stuff, the current family keeps doing their thing. If you're doing a value add stuff, then maybe you're bringing in other partners. So yeah, you're addressing the conflict of interest issue. That was going to be my next question: is how do you figure out where the
We've
deal goes?
we've been value add players for our own business for a long time. So I think we have a
Okay.
track record of remanufacturing assets to their core potential.
Right.
Um, we just have done it for our own account, and now I think we would probably look at doing that magnitude of task work with partners, because I think there's opportunity coming, and we want to be able to capture that.
And not that you mentioned it, but now I am curious. I mean, you've also built this operating business over decades. Has there been any interest to think about, hey, maybe we can grow the service business a bit, do some third-party property management, or, that sort of stuff, or is that not something that's of interest at the time?
Uh, that could happen. I think that most importantly, though, the operating company, the property management company, is designed to be much more sort of owner focused. And so I think
Okay.
that at current size and the ratios of we have the right mix of regionals and vice presidents, and we have an infrastructure that supports, I think, good growth. But I think that growth is going to come from our principal investing, and potentially that would in joint venture with other like kind investors. So
Right, not to become a receiver for the courts to deal with distressed debt or something like that. It's not to get out of
right.
your core competency. No, I figured I'd ask because I mean, a lot of with interest rates being kind of crazy and bouncing all over the place, it feels to me over the last couple of years, I've had a lot of conversations with guys who are traditional owner operators who are saying, "Well, heck, I got to do something with my time. What else can I do with this? What else can I do basically to create value?" So I figured I'd ask.
Yeah,
Um,
the management company for us is really a function of helping us execute on owned business, and so
right,
and it's worked well for us there. So I would foresee that staying that way.
not its own revenue generator. Yeah, no, I
Well,
get,
it can be
I
a little distracting as a separate business into itself when you do that.
no, and I get it, and I know people
Yeah.
who have gone into all kinds of screwy things where they end up saying, "Well, heck, we have laundry machines. Let's have a laundry machine company," and
At, at,
they're
at
earning
real
so many
scale,
hours
it
in
could
a
be a
day.
very, very formidable piece of business. But to
Right.
get to that scale, it takes time and I think more resources that we'd rather put elsewhere.
As you said, it's a whole other business. So, so one question I know we talked a little bit before we even got on the line, but I just wanted to address. So, New York City is famous for having, a very regulated
Right.
environment in terms
Yep.
of rent control, landlord-tenant law, evictions, all that good stuff. A lot of the markets you've mentioned, and the markets on your website, I mean, Arizona, Utah, Nevada, these are not markets that I think of as being, highly regulated markets by any means. Um, was that one of the drivers for these like when you're thinking about what markets to expand into, and I realize a lot of these decisions were made before you were even here, but like what why these markets and other markets? It's a big
Sure.
country.
Well, the firm grew up in the New York rental real estate market, and at the time, it's what you know, and you operate
Sure.
in the environment that you're an expert in. Uh, I would say that our progression wasn't necessarily because we were unable to expand at the rate we wanted to, but we looked at growth. And one of the reasons for growth is to diversify. And yes, to some degree, the political and the rent control climate of New York has made it increasingly difficult as a landlord. Right. We're
Hmm.
not in the rent control business, we're in the apartment ownership business. And so our thesis really is to find good risk adjusted returns. And seemingly that's been even more sort of pronounced in the last 10 or 15 years, um, where some of these markets that we're in, obviously have less regulation and there's been good population and employment growth. And so um, I would say that the geographic growth, sure, if of 10 metrics, that would be one that would factor into sort of why here versus elsewhere. We're big owners in Denver, which is starting to see its share of regulation, right? And so we're not
Right.
afraid of it. We certainly
Right.
have an expertise in doing it, and we like the market, and we're not leaving. Um,
Sure.
but sure, there is a lower cost of ownership and a little bit of an ease of operations in those markets that are less regulated for sure.
Yeah, I just figured I'd ask. I
Right.
mean, because I mean, there's been a lot of ink spilled on the part of, newspaper reporters about the
Yep.
impact of rent control and the health of New York. And as a native New Yorker, it's something that I think about. So just figured I'd ask.
It
Um,
it it always factors, but that would be one of many factors as to why not New York versus going someplace else. But yeah, sure, it comes up.
sure, 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 sure. So, part of you made a reference earlier to talking about, you've got regional vice presidents here, regional vice presidents there, and that gets to another conversation we really haven't talked about, which is, running a business. I mean,
Mhm.
you're as a chief investment officer, you're not that you don't know your way around Excel, but you're not the analyst, right? You've got a team of people who do a lot of different functions for you. How are you finding it staffing in all these different markets? Like you're running a team that's not local anymore. What's that like?
So, well, I wish it was as directly accurate that last statement. I mean, we all have work to do, and the title doesn't necessarily entitle you to not do work, right?
I
We
get it.
all,
You still get yourself your
yeah,
own
trust
coffee.
me.
I get that. I get that.
This is, that you have to lead by example, and you have to know your stuff, right? So,
Sure, sure.
but to answer your question about sort of org chart and scale, so um, first of all, a lot of the folks that we have in our operating company reporting through different work charts, right? I mean, those folks that you're mentioning are coming through the property operations function. So I have dotted lines to a lot of folks, right? Because we're always talking about how the markets are doing, or making investment decisions, and getting folks coordinated to help us in due diligence and market information. Um, so to answer your question about sort of specialty, the folks that work directly with me, right, are working directly on processing and looking at new opportunities and creating, policy and procedure for investment criteria, portfolio management, hold sell analysis, going out and looking at and auditing our asset plans, right, making sure we're doing what we're doing in coordination with operations, and then investor relations as we continue to build towards this socialization of the firm with other capital. How do you present yourself, right? Messaging, PR, marketing, and track record, packaging yourself to be presentable, right?
Sure.
Which, for an 85-year-old company is no small task. It's a good story, but you have to take the time to do it. So a lot of the folks that are working with me are very specific to their role. And I guess, getting back to skill sets, a lot of great talent here with a lot of graphic design and desktop publishing and asset management experience. And the one thing, we talked about before that I think is the one piece where you spend more time is really delving into sort of the analytical side that folks bring to the table. In the end, real estate is metrics, it's performance, it's the one universal LCD across all of your real estate, whether you own it or you choose to underwrite it, is what do these numbers look like? And it doesn't always fit the same box, and you're looking at things a little creatively. And but in the end, a 10 IRR for one deal needs to pretty much be confidently compared to the 10 IRR of another. And so I find myself spending a lot of time delving into folks' acumen for the analytics. And
Right.
I think it's an acquired skill. I know that's part of your profession, and conveniently the answer is sort of focused there. But um, I think that a lot of folks understand real estate. That the trick sometimes is providing that analytical interpretation and making sure folks are spot on with that. Because I think that's, to me, is one of the most important pieces.
Yeah, if you can't measure it, then it doesn't exist. Like, how do you actually measure success? And that's, and I imagine, and this is not, I mean, this is not unlike any other organization. I mean, you're an organization that's been around for decades, and as a result, there are pre-existing processes, and a lot of it is understanding, okay, how have we done this in the past, and how we measure it, and your point about having a track record and how you present it. I mean, heaven knows I can think of a lot of examples of very successful people in this industry who are not good at explaining why they're good at what they do. And, the inverse is equally true. There are a lot of people who are really good at the smoke and the mirrors, but, doesn't mean you actually know what you're doing. So it's interesting. It's interesting.
Yeah.
Um, so, right now in the market, you're looking at deals. You mentioned,
Mhm.
looking at opportunities, processing things. You're looking for current yield. Obviously, if interest rates going up and then down, and who knows what they're doing now. Of course, we're doing this recording in December. Rates seem to be on their way down, but by the time this gets out to the world, in a few weeks or whenever we release it, it could not be that case. Um, what do you what are you looking for in today's market? Like, and what do you think about how much is your family office? You guys think longer term than a lot of other players. You're not private equity guys, so generally your time horizons are longer. To what extent do
All right.
interest rates affect you? How do you think about that?
So the answer is, I would like to have been busier than we have been for the last 7 or 8 months. We actually have a we have a high appetite to be buying through up cycles and down cycles. Again, 86-year-old firm that has been buying and selling, although not over, 1 to 2 year periods,
Sure.
consistently for decades. And so we're in a position where we're looking at the right metrics. And really the last 7 to 8 months has not necessarily been not a lack of opportunity, but rather what are the analytics of those opportunities. And the trends have been steadily, we look at current income, we do look at levered yields. A lot of that has been difficult because of the cost of debt, and to some degree because we're in the apartment space, we have watched and waited that progressively over the last year, even before I joined, cap rates have been moving up, but they hadn't caught up to debt, right? And so you were
Right.
still buying assets that were dilutive in their first year yield relative to the cost of debt, and of course, for us, we have a lot of resources, but they're not unlimited. Last year's $25 million check to buy a $90 million deal is now 48 million, right? Just debt limitations. And so you have to just pick your spots a little bit more carefully because now you're making bigger commitments to the same piece of real estate. So um, that has been moving steadily. Well, if you're a buyer, it's been moving steadily, in our favor.
Sure.
We'll see with the interest rates coming down as they have, as to whether that finally finds its sort of spot to transact. Uh, Wish we had been selling more of our assets. Would like to be moving some of that equity through our portfolio, but we hadn't for the same reasons because we were watching pricing come down. And just the question is, what would you do with the money if you had it back anyway? So, but what I see going forward is a couple of things. We were initially thinking that we'd be bigger players in build to hold. That on the development side as a JV player and sort of work our way into a portfolio. That for the moment, the value proposition has moved away from. I mean, the return on cost, because costs are still higher, is is not nearly as attractive, particularly with cap rates continuing to rise.
Right.
Again, that needs to sort of normalize, which it will. But I would say for the next 12 months, we'll be buyers. Replacement costs, buying a core acquisition or a value add is looks a lot better from a risk adjusted standpoint. And I really can't pencil development right now because the acquisitions are right there, if not better.
Right. Yeah. Why build if you can buy existing
Yeah.
product and make a better yield with no development risk? So that gets us to 2024. So then in
Yeah.
2024, like, how do you know when it's time to jump back in the market? Is it a matter of cap rates just going up a bit more? Is it a matter of debt stabilizing? Is there, I'm always, people have all kinds of opinions, it seems, about, political issues. Like, at what point does your red light turn
Right.
green, basically, and get you to jump back in?
So I mean, my light, my light has always been green. I'm
Okay,
definitely a
fair
glass half
enough,
full, but
fair enough. Sure.
so to some degree, it's been making sure we do the right thing. But I would say in 2024, we probably turn it back on in a big way because I do
Okay.
think we're at a point where we feel confident that the next year or two of vintage will be there. I think that the operations across the country, supply and waiting. I think job growth took such a run that now the A, B, and C market with all the supply coming is starting to put pressure on every level. And so everyone's
Right.
recalibrating to their new place in life. Even our portfolio, which ran up, is now finding sort of its new gear. But I would say that look, there will be some opportunities to buy. It could be, in my opinion, at the very newer part of the market where the lease ups are kind of right there and folks want to monetize and they're okay where it is. It may not be what they thought it was in early 22, but they'll transact, and I'd like to be there. But I also would like to be a seller too. And I think right now we're getting very close to the point where we feel good about making those moves and putting product out there and thinking we'll have a good reception. So I would expect us on both sides, buys and sells, maybe even
Okay.
leading with the sales market to be active.
Okay, fair enough. So yeah, generate some more dry powder to then put to work and more things that you can buy, turn around, and create value on. Fair
Yeah,
enough.
I'd
Fair
like
enough.
some dry powder because I do think that there's going to be good opportunity in 24, and I would like to be an owner and sort of into a good vintage of product by 26 and 7 when I think the fundamentals are going to be really good because the supply will have absorbed by then, and there's really no capital right now to put new supply out, which is a housing problem for the U.S., but an opportunity for owners, in my opinion.
Yeah, and that, not to get too far afield, but basic questions like where do all these people live? I mean, the amount of housing product produced relative to household formation is out of whack. So yeah, it's there's some broader issues, but I hope to get someone on in a couple episodes who's more of a economist talking about sort of broader impacts.
Yep.
But yeah, no, it's your point is to be an owner when rents go up, it's not a bad thing to be. Interesting. Well, look, I think it's it's a great platform, and if anything, the theme here is modernization. Taking a company and basically, expanding it and making it, as you said, more of a not that it won't be a family office, but building an investment management business, which is definitely its own beast, but also one that I know you have experience with. So
And
that's
you have to
exciting.
find good opportunities. I don't think that Maxx Properties will struggle to find folks that would like to align. And that's not to suggest it's cocky, but I think that there's a lot here to want to be part of.
Sure.
Real question is finding attractive real estate opportunities, right? And making sure that we put ourselves in the line of fire to find good things, because what's actionable is far more marketable. And so that to me is my mandate for 24, is to mark good places to park capital. And I think we'll be able to find folks that trust us. That's my goal.
Yeah, excellent stuff. And I think that's a perfect place to close. So I'll say thanks again for your time, Adam. Pleasure talking about the markets. And to everyone else on the internet again, the website is Maxx Properties. That's maxxproperties.com. And I've been speaking with Adam Fruitbine, CIO at Maxx Properties.
Happy
Thanks again.
holidays to everybody.
Happy
You too,
holidays.
Josh.